Good morning. I am Dr. Subasree, Associate Professor of Economics from Sri Sharda College, Salem. Today I am going to take National Income Account, basic concepts of National Income Accounting. What is National Income? National income means income of the nation. That is a common answer will be given, that will be given by all. It is the market value of goods and services produced in an economy during a particular period of time. And it includes some more concepts also. They are, national income is a very basic index to measure the growth and development of an economy. The basic concepts that I am going to take today are GNP, GDP, NNP and NDP. Gross national product, gross domestic product, net national product and net domestic product. And I have taken this side as a gross and this side as a net. What is the difference between, what makes the difference between gross and net? It is the depreciation that makes a difference between gross and net. It is a very important concept that we have to take in gross and net concepts. They are, gross means total, net something is deducted from the total. What is deducted? Depreciation is deducted. What is depreciation? The term that we use for depreciation in national income is consumption of capital, normal wear and tear. Because in the goods production, many machines are used. Machines will always have wear and tear, and that has to be taken into account because that comes under the expenditure side and that is not added into the circular flow of income. That has to be deducted from the gross concept. So gross minus depreciation will give you net. If you deduct depreciation from GNP, you will get NNP. GNP minus depreciation, I use a short form D for depreciation. GNP minus depreciation will give you NNP. The same way GDP minus depreciation will give you NDP. Same way NNP minus NNP, already it is a net concept, so we need not change. Gross minus depreciation is equal to net. So wherever we, and usually we take into consideration only the net concept. So we should know how to deduct depreciation, how to calculate. It is otherwise known as consumption of capital and wear and tear, normal wear and tear that is experienced by all the machines. So one concept is over. The difference, I have taken it as two. First letter, here it is gross and here it is net. It should not be confused with national because the next letter is followed by the same N. The first letter is N. First letter that makes a difference here is gross and net. What makes a difference between gross and net? It is a depreciation. I give you a recap. It is depreciation that makes a difference between gross and net. Okay, fine. Next is national product and here it is domestic product. The first one is national product. Here it is gross national product and net national product. And here it is gross domestic product and net domestic product. What makes the difference between national product and domestic product? National product always includes the net foreign income from abroad. Net income, we used to say net income from abroad. National product always includes net income from abroad. This will be the short form that you can find in all the books and guides. So net income from abroad. Net income from abroad means our economy is not a closed economy. It is an open economy. That means we do have trade relationship with other countries. In an open economy, we have exports of goods and services. Exports of, we do export goods and services. The same way we import goods and services also. So net income from abroad means export minus imports. Export is a simple term. I take into consideration only the balance of trade here. If we include the services also in a wider term, it will become balance of payments. Okay, just for your understanding, we are seeing the basic concepts. So you are in an elementary stage. stage. That is why I have taken exports minus imports. If we deduct, because why do we deduct this way? Because for exports we will receive payments. We will receive payments and we will receive the payments or receipts. And for imports, we will make payment. So receipts minus payment. You can still understand in a better way and easier way too. Exports minus imports. For exports, we will receive. That comes under the receipts. And for imports, we will make payments. Isn't it? Okay, if we export some textile goods, we will receive foreign exchange. Isn't it? So we receive our receipt, our receiving the foreign exchange comes under the terminology receipts. And for imports, if we import petrol from other countries, don't we pay for petrol? Yes. So we make payment in foreign currencies. So that comes under the payment side. And national product includes all the transactions. Same way, what is paid and what is received in foreign currencies. So the net income from abroad, if we exclude the net income from abroad from national product, we get domestic product. Or otherwise, domestic product, if it is added with net income from abroad, we get national product. In here, national income is included in as an index. It is one of the most important indices in measuring our development or growth. So we have to account it, no? When payment and receipts come automatically. The same way, wear and tear also is to be measured in money terms. National income itself is a market value of goods and services, means everything is measured in money, monetary terms. We have to measure. So in such case, everything is valued in rupee terms. So national product includes the net income from abroad, and domestic, if net income from abroad is added with domestic product, we get national income, national product. National product minus net income from abroad gives you domestic product. Gives you domestic product. We can calculate it in either way. Domestic product plus net income from abroad will give you national product. Okay, is it clear? So first we saw GNP, GDP, NNP and NDP. First letter we have taken. What makes the difference between gross and net? It is the depreciation that makes the difference between gross and net. The second letter, here it is national product and here it is domestic product. What makes the difference between national product and domestic product? It is the net income from abroad that makes the difference between national product and domestic product. Then how to calculate this net income from abroad? If we subtract the receipts, if we subtract the payment from receipts, it can be either way. This receipts may be in a positive sign, this payment may be positive or negative also, it will be there. Accordingly we will get the national income calculated. Suppose our receipts is 1000 crores and our payment is 800 crores. Then what is the net income from abroad? 200 crores is the net income from abroad. Suppose receipts is 600 and payment that we make for our imports, it depends upon whether we export in the balance of payment our exports are major or imports are major. So it will differ as per the case maybe. So if the receipt is 600 and payment is 800, then you get the net income from abroad in negative sign. In such case, if it is added to the domestic product, your domestic product will be less than what we have. What is this domestic product? What we produce within the economic territory of the nation. What is produced in the goods and services that are produced within the economic territory. It is not the boundary. That way we differ from history. History tells us the physical boundary of a nation according to the map. But economic territory, in the sense, we will have our own territories. Up to that we can fish, or mountain resources will be available for us. So the physical resources, sharing of physical resources, that depends upon the economic boundaries of a nation. So economic, according to the economic territory, the products which are produced, the value of the products that are being produced within the domestic territory of a nation comes under the domestic product. If net income from abroad is a positive sign and that is added, our domestic product will increase. If the net income from abroad is a negative sign, and if it is added to the domestic product, naturally we have to subtract, and our domestic product will be less than what we have, what we produce. Okay, is it clear? So the second part is, first thing we saw the difference between gross concept and the net concept. So that depreciation is the reason for making the difference. Next is national and domestic product. It is a net income from abroad that makes a difference between national product and domestic product. The next comes this GDP or NDP or GNP or NNP, that is measured in market price. And we have another branches in this, that is GDP at factor cost. Same way, NDP is measured at market price, GNP is measured at market price, and NNP is measured at market price. Same way, NDP at factor cost, GNP at factor cost, and NNP at factor cost. So what is the difference between market price and factor cost? We have taken the same four things, same four concepts as we already dealt with. Next comes the difference in the market price and factor cost. What is market price? You would have seen it in the packages. It would be written whether it is medicine or whatever beverage or whatever product that you get, inclusive of all taxes. The price, MRP price, will include the taxes also, inclusive of all taxes. So market price always includes the tax. Okay. Factor cost is entirely different concept, where we take into consideration the cost that is paid to the factors of production, namely wages, salaries, rent, interest, profit. The rewards that are paid to the factors of production comes under the factor cost. And how can we club this factor cost and market price? Market, as I already told you, market price includes the taxes. Factor cost includes the incomes, isn't it? So here we have to take net indirect tax. How we use the terminology? Net income from abroad. The same way we are adding up one more new concept here, namely net indirect tax. What is this net indirect tax? Indirect tax minus subsidies. Again, tax is a payment that the general public make to the government, whereas subsidies are the payments that we receive from the government to the public. The public receive subsidies, isn't it? So one comes under the indirect tax, comes under the payment side, and the subsidies comes under the receipt side. Public making payment to the government comes under the tax. Government making payment to the public comes under the subsidies. So one part we receive and one part we pay. What is net? There we calculate indirect tax minus subsidies. So that is known as net indirect tax. Always the market price includes a net indirect tax, and factor cost we don't include the subsidies or the payment made. So net indirect tax is excluded in the factor cost, and it is already included in the, we are not separately going to add it. It is already included in the market price. How would you calculate the net indirect tax? It is an indirect tax minus subsidies. Okay, that way we are calculating market price already includes a net indirect tax, and factor cost that excludes the net indirect tax. Suppose in the national income accounting, if factor cost is given to you and you are asked to calculate the market price, means you have to include. Suppose factor cost is given and market price is asked, means you have to include. If it is the other way, you have to exclude it. That's it. Okay. So first one, that makes it, what makes a difference between gross and net concept? That is the depreciation or the consumption of capital or the wear and tear, normal wear and tear, that makes a difference between gross and net. Next, the second one is national product and domestic product. It is a net income from abroad which makes a difference between national product and domestic product. If the net income from abroad is added up with domestic product, we get national product. If net income from abroad is subtracted from national product, we get domestic product, irrespective of the terms gross and net. Okay. Then the third one is market price and factor cost. Market price, this also irrespective of the gross product, irrespective of the national product or domestic product or net product or gross product. Okay. So if we add net indirect, in the case of market price, net indirect tax is added, and in the case of factor cost, net indirect tax is not included. Okay.